The national debt has jumped from $31.5 trillion to $32.3 trillion just in the second quarter of 2023. That's almost a $1 trillion increase. That's the same increase in national debt that we saw between 1966 and 1983. Back then, it took 17 years for debt to increase by $1 trillion. Today, it takes just a quarter of a year. The expansion of national debt has helped financial markets prosper, even through tough economic conditions like the COVID pandemic and coming out of the financial crisis, both examples where we saw national debt increase by around $5 trillion in just a few years. But many consider this to be a bubble that is inevitably poised to deflate. We recently saw Moody's, the credit rating agency, downgrade their rating on US debt from stable to negative, and they even described what would happen in the event of a debt default. Their prediction is that we could see unemployment rate reach 8% under the worst case scenario. That would be around the same severity to what we saw during the global financial crisis. In fact, in 2023, we've seen traders make a $5 billion bet on a possible debt default. So in the event that the US government does default on its debt, we will see $4 billion get paid out to investors who bought these credit default swaps to hedge against a government default. But if we zoom out on this chart, we can see we saw a similar type of occurrence back in 2011. That can help us understand what are driving these concerns today and whether we should be expecting these bets on a government default to be going substantially higher as the risk increases. The reasons we saw these concerns back in 2011 was because of the debt ceiling. Public debt tends to go up over time as the government spends more, and the debt ceiling has actually been raised 78 times since 1960. Although it was initially introduced in 1917 to limit the total amount of debt, clearly that hasn't worked out. Most of the time, that has just been a routine event. Debt expands, the debt ceiling gets hit, politicians agree that they want to avoid a financial meltdown, so they raise the debt ceiling and push the problem to the next set of politicians that will probably make the same decision. But in 2011, Republicans refused to raise the debt ceiling unless the government agreed to reduce its deficit spending. And in fact, that happened again in 2013. In 2023, the spike that we saw also coincided with the debt ceiling crisis that we had in May. So the reason for why investors are still hedged against the possibility of a government default today is likely in large part because of the debt ceiling crisis that we saw in 2023. And it's not much of a surprise that we actually saw a debt ceiling crisis. This is what political polarization looks like since 1994. Back then, both Republicans and Democrats held pretty favorable opinions of each other. After the global financial crisis occurred, you really started to see polarization pick up. This new world with more misery and higher wealth inequalities fragmented political opinions on how to tackle those problems, including how to tackle government debt. Debt to GDP in the United States is now above 100%. That means public debt is the same size as the total size of the economy. And that's the number we should really be paying attention to. Not just the total amount of debt, because that just tends to go up over time. The relative size of debt compared to the size of the economy is much more important. This line that you see here is GDP. It's the size of the economy. And you can see in 2012, public debt in orange went above total GDP. It exceeded 100%. And since then, we've had more frequent crises around debt, more credit agencies downgrading the quality of US debt. And that's something that could actually continue happening over the next few years unless either political polarity decreases or we see debt become less of an issue over time. And so making it less of a sensitive political controversy. In terms of actually having a limit where the system collapses or that the US just runs out of money to pay back the debt, it's unlikely that we're going to see that without a complete economic collapse. But that's a difficult scenario to imagine because the government's debt is denominated in US dollars. That means the US can physically print money to reimburse its own debt. That's not like an individual or business that owes money. It would be illegal for those to print US dollars, so they can actually go bankrupt. That's probably not the case for the US government. The way that the US can get into a very tough situation is if we continue to see the debt rise rapidly, but we see the size of the economy stagnate. You could see things like the interest payments that the government pays on its debt become larger and larger relative to the amount of government revenue. Because if the economy is not growing as quickly as debt is, then the revenues you get from taxes are not growing as quickly as interests are. Interest costs on government debt right now are at 15%, and that's actually projected to continue with the government's current spending patterns. So the ideal scenario would be to see debt grow less quickly than the size of the economy, and that is something that has happened in the past. For example, in the late 1990s, you had a period of time where the government debt leveled off while the economy grew, and then in 2001 you had the tech bubble burst, triggering a downturn which the government had to compensate for by increasing its spending. And we actually saw the same thing in 2008 where the housing bubble burst, triggering a financial crisis, and so the government had to spend to avoid an economic depression. So in the ideal scenario, we need to avoid these types of crises so economic growth can remain stable and the government doesn't need to spend as much. And that's actually what we saw in the late 1990s. The reason it's so important that we do get debt back down to lower levels is that high levels of government debt relative to the size of the economy actually end up being a drag on growth. The average growth for countries that have less than 30% of debt to GDP is much more elevated than the average growth that you see in countries that have over 90% of debt to GDP, which is the case for the US right now. So that could become a long-term growth problem for the United States, or the US can choose to do the same thing that the UK did back in the 1940s. The UK also had extremely high levels of debt relative to the size of the economy following the Second World War, and just like the US dollar today, the British pound was the world reserve currency, and the UK ended up being able to get out of a massive debt burden without plunging the British economy into an economic depression after the war. The way it pulled that off is that the UK devalued its currency in the 1940s, 50s, and 60s in order to get out of debt. It took around $5 to buy a pound back in the early 1900s. By the 1970s, the exchange rate was almost $1 for a pound. These devaluations made the pound cheaper. So all of a sudden, British goods became cheaper for foreigners to buy, and that immediately boosted demand for them, which boosted British manufacturing and exports. The cheaper pound also made paying the debt mechanically easier. It allowed the UK to print money to pay back its debt because, again, the national debt was denominated in British pounds. Now, that all, of course, came at the cost of investors losing confidence in the pound. It went from representing around 70% of global foreign exchange reserves to less than 10% just over the course of just a few decades, and instead investors turned to the US dollar as the world reserve currency. The global foreign exchange reserves in dollars surged from 10% to 70% to completely replace the pound as the world reserve currency, and it still remains around those levels in 2023. So the United States has the power to do what the UK did in the 1940s to get itself out of debt. In that scenario, you would see the US dollar decline considerably during the next economic downturn, as the government and the central bank try to get debt levels back down. Now, that could also mean that we see a big boost in manufacturing as American-made goods become cheaper, attracting foreign demand. And that could potentially allow the US to boost its economy and come out of its debt burden. Now, unfortunately, the dollar isn't just dependent on what the United States is doing. The dollar's strength is relative to other currencies like the euro and the Chinese renminbi. If we see the European and Chinese economy doing much worse than the US, you would actually see a melt up in the dollar. That's actually what we saw in 2015 with Brexit and in 2022 when Chinese real estate was crashing. Now, we happen to think that China is going to be recovering over the next couple of years and that the US will be going through a deep recession that's going to drag the US dollar lower. That's why our rating for silver recently has been an 8 out of 10. Silver is up 11% since we posted that rating on our website on November 8th. Both gold and silver could be on the verge of a big breakout today.